Okay, we just went through the cost of equity. We're going to quickly move forward, starting with the cost of debt. The cost of debt is going to be symbolized here as RD, and you can think of this as the interest rate on new debt. The cost of debt here is going to be equal to the required return, in a sense, on a company's debt. Once again, we're going to see a couple methods. Method 1, we're going to compute the yield to maturity on existing debt. Method 2, we're going to use estimates of current rates based on the bond rating expected on new debt. The cost of debt should not be considered to be the coupon rate. If you recall back, the coupon rate was the cost of debt when the bond was issued. What we are looking for is more recent. All right, the component cost of debt. Here we're going to use the yield to maturity on the firm's debt. Interest, remember that interest is tax deductible. This is one of the biggest parts about this particular formula here. Interest is tax deductible, so after tax cost of debt will be seen as this. And this is why the little t variable comes in, is because of what I just said. Interest is tax deductible, so we're going to throw that t variable into the equation here. So if the corporate tax rate is 40%, we could end up having our cost of debt is going to be equal to 8.9, which is our debt before taxes, our cost of debt before taxes, and then you're going to have 1 minus 0.4, which was that corporate tax rate, and you'd get 5.34. So once again, interest payments on debt are tax deductible. So cost of debt to the company is reduced by the corporate tax rate. This is important for quiz purposes. An increase in tax rate may do something to after-tax cost of debt. Think about that. What would it do according to this formula? So if you increase that corporate tax rate from 40% to 50%, what would it do to this number? If that went up, it would lower that number, right? So a higher tax rate will actually lower the after-tax cost of debt. I'm going to quickly move into preferred stock, which we haven't gotten terribly into thus far. I think I mentioned that it was a hybrid between stock and debt. But now we're talking about the cost of preferred stock. Preferred pays a constant dividend every period. Dividends are expected to be paid forever. And preferred stock is perpetuity. We did talk about perpetuities in the past. And you can think of that as just being, a dividend over the price at a particular period, in this case, P0. So for an example here, you have a preferred annual dividend of $10, current stock price of $1.11 with 10 cents. You do the math there and you get 9%. So the cost of preferred stock is actually relatively easy. Thus far, we've gone through 1, the cost of equity, 2, the cost of debt, and now 3, we've talked about the cost of preferred stock. So we've covered 3 portions of the chapter thus far, all pretty succinctly. Next part here, the weighted average cost of capital, which is going to be called WACC in your textbook often, or the WACC I call it. This is going to be an important concept going forward. So I think that for quiz purposes, it would be good to know what the definition is of this term. So you're going to use individual costs of capital to compute a weighted average cost of capital for the firm. This average is going to be equal to the required return on the firm's assets based on the market's perception of the risk of those assets. The weights are determined by how much of each type of financing is used. So in other words, the weighted average cost of capital is going to include all the 2 or 3 elements. Some firms may not employ preferred stock, for example. So weighted average cost of capital is going to kind of involve everything we talked about so far: cost of debt, cost of equity, and potentially the cost of preferred stock. So one question might be, how would you weight equity versus debt versus potentially preferred stock? Well, they talk about that here. The weights are going to be equal to the percentages of the firm that will be financed by each component. It's all here. We're going to always use the target weights if possible. If not possible, just use market value weights. You'd want to use them rather than book value weights. As far as capital structure rate weights, notation is pretty straightforward. This E variable here is going to be your market value of equity, and it's going to be equal to the number of shares outstanding times the price per share. And the D variable here is going to be your market value of debt. That's going to be equal to the number of outstanding bonds times the bond's price. And V is going to be the market value of the firm, which would just be D plus E. The weights will be pretty straightforward in the sense that E divided by V will be the percent financed with equity, and D divided by V will be the percent financed with debt. So I think it would be important for you guys to just, when you're talking about this as far as the weights and whatnot, take a second right now and think about what this slide is saying. We're saying equity is a portion of how firms finance decisions, debt is another portion, and then there's a total portion in a sense, D plus E. The weights of each for the firm is pretty straightforward. You just take the E component for equity over the total in order to see how much percentage are financed with equity, and then you do the same for the debt portion as well. So this is what the actual formula for the weighted average cost of capital looks like. Pretty straightforward, at least in my opinion, because it's basically a weighted average. That's what we're looking at here. We have our weights, the E divided by V. And here we just